Hello, my friend. If you are interested in investing in multifamily properties on the south side of Chicago, stick around. I'm about to go deep into the numbers, specifically on 3 and 4 unit properties in the different neighborhoods of the south side of Chicago in terms of pretty much any metric that you could want to know for real estate investing. That's cap rates and 1% rule, and what kind of revenue you can bring in, what kind of price what's the entry price to get into those types of buildings, and we'll discover some more tidbits along the way. So this video is focusing primarily on, well, this is only on the south side. I actually broke the south side into two sections because the south side, as you may know, is massive. There's 77 areas in Chicago, and I think like at least half of them are just the south side alone. So this one is essentially the north side of the south side. Well, I'll get into more of that here in a little bit of exactly what what areas this video is focusing on. If this is your first time meeting me, my name is Jake Lyons. I am a real estate agent here in the Chicago area with Berkshire Hathaway, also owner of the ChicagoHomeSource.com. I love the small multifamily space. That's 2 to 4 unit buildings. I was a Series 7 licensed financial advisor back in the day, and I got into real estate because honestly, I saw the power of real estate investing in properties just like this. I like these properties specifically because you can get into them using residential loans, even though they are income generating properties. So anything 5 units and above, that's now a commercial property that requires commercial loans, commercial underwriting, and it's a whole different thing. In my opinion, 2 to 4 unit buildings are much more accessible to more people, if not easier. It's definitely this accessible to more people, and you can get into them with more user friendly loans and that kind of thing. So. Without further ado, I'm going to get into what I'm actually defining as the south side for the purposes of this video. So in case you don't know, this is a map of the city of Chicago and the 77 different community areas that comprise the city of Chicago. So you hear a lot of people say, Chicago has 77 neighborhoods. That's a bit misleading or a bit of a misnomer because there's actually probably more like over 200 neighborhoods, but those neighborhoods, those little mini areas, like every corner wants to kind of have their own identity in Chicago, so there's neighborhoods and like sub areas within the 77 areas that we're talking about here. Fair enough, right? So let's zoom in to what I am considering as this analysis. So you can see, I mean, the south side, like the north side is pretty much like this part right here. Northwest side is over here. West side I consider to be just kind of these right here. Southwest side, there's really not a lot to talk about in terms of small multifamily properties in the southwest side. So I'm not even doing a video on the southwest side. But the south side is all of this other just landmass here. So I'm splitting it into 2 videos, 2 separate sections, and 2 different sets of analysis. So the areas that I am focusing on for this is going to be as follows. So the near south side, that's where you can find like the South Loop and the museum campus and different areas like that. Not a ton of small multifamily stuff going on in the near south side. That's still a lot of like high rises and more kind of properties like that. Armour Square, Chinatown can be found in Armour Square. Bridgeport. Bridgeport is, that's where the Sox play. McKinley Park was actually a part of the southwest side that is not in this analysis. New City, so back of the yards, Canaryville, and New City are found in here. Fuller Park, this little sliver kind of going along, just kind of like edge it, bordering the just a few blocks within outside of 9094 highway going down that way. Douglas, so Douglas is where you can actually find Bronzeville, Prairie Shores, South Commons, some popular neighborhoods like that. Over here we have Oakland. Bronzeville also extends into Oakland a little bit. Oakland is also its own neighborhood. Got Kenwood over here, Grand Boulevard. Bronzeville kind of as a neighborhood kind of extends into it's a tweener neighborhood that extends into a few of these other areas. Hyde Park, famously where the University of Chicago is located, the Museum of Science and Industry, some different things like that. Washington Park is over here. Woodlawn, and then that's as far south as it goes over here on the east side. South Shore was a part of the far south side, which is going to be a different video. So that was just the east side of the highway. Washington Park, Greater Grand Crossing, that's the far south side. That's not in this one. Englewood is a part of the south side for the sake of this video. West Englewood as well. And then Gage Park, all of these are the southwest side, which we're not getting into at all. So basically just this little area right here is what we're focusing on for the south side. And then for the rest of it, that'll be the video focusing on the far south side. It'll make sense. So let's get in. With that all being said, we all know what we're talking about now. So let's get into the numbers. So now that we know what we're talking about there, the place that I like to start is with just the entry points to get into these different units in these different neighborhoods. And as I'm actually looking, this is the format that we're gonna follow for each of these graphs. The neighborhoods are down here, and as I'm looking, it actually looks like I missed a couple, Archer Heights and Brighton Park and some places like that in the last segment. But yeah, so just know that those also exist, and then we are also covering those. But what you see here is the blue columns represent the average price paid, the average closing price for a 3-unit building in the neighborhood that it goes to. And the red represents the average 4-unit property for the same. And that's as of, all of this data is as of about midway through 2021, going back through midway through 2020. So those 12 months, all the 3-unit properties, like for example, all the 3-unit properties that were sold in Archer Heights, the average of those, that's what we're looking at here. Almost $400,000 is what it was costing on average to buy a 3-unit property in Archer Heights. So that's what we're looking at here. When you see a lot of these neighborhoods, a lot of neighborhoods in the South Side, just don't have a ton of small of these types of properties. They might have more 2-unit properties, but I'm not talking about. I'm only covering 3 and 4-unit properties for the sake of this analysis, just because in my opinion, 3 and 4-unit properties are kind of just where the most bang for the buck is. If you're going to get a multifamily, not to say that there isn't some great applications out there for duplexes and 2-flats and that kind of thing, especially owner occupied situations, and having the other rent help out at least a little bit. But what I see out in the field, in my experience, is that 3 units is kind of where you, at least if you're owner occupied, you at least start breaking even on that. If you're not owner occupied, you at least start really making profits on that. And then a 4-unit, takes you a step higher than even that. That's just kind of on average. There's obviously exceptions to the rules, to that rule everywhere all the time. You'll hear me say this a lot. All of this stuff is case by case, and all of this analysis is all just based on averages and not to necessarily be applied to every property or even that neighborhood, whatever. But this is all, the purpose of all of this is just to provide a 10,000 foot overview to just to compare apples to apples as much as possible for for all these different neighborhoods and areas. So you might see, obviously the cost of where you actually see that there was enough data. Like a lot of these I think that's what I was starting to say until I trailed off, was that a lot of these neighborhoods just don't have these small multifamily properties to even analyze, or just weren't enough sold. There might be some 2 units. There might also be some 5 and above units, but we're not talking about those either. And for those that had both 3 and 4 units, enough to really analyze, you can see that the cost of them, the cost of that 4th unit wasn't all that much more comparatively to the 3 unit, even though you're adding a whole another stream of income to it. You would think, at least I would think, that it would be maybe a little bit more that you're paying for that 4th unit. But we see, Bridgeport, it's the case a little bit. Brighton Park, the case a little bit. Englewood is basically the same. New City, you actually see the 3 flats or more for some reason. And yeah, you just kind of see some things like that. So let's see, this Grand Boulevard. It looks like that's actually the highest average, the highest entry point to get into any of these neighborhoods. A 3 flat there was going to run you about 600 grand, whereas it looks like Englewood was still about the lowest barrier for entry, least expensive to get into that market. Both 3 and 4 unit properties are hovering around that $200,000 mark on average. So that's what this looks like. And so from here, let's move on to see what kind of rents these neighborhoods are getting. Right, now that we know what it costs to actually buy these buildings in these areas, let's see now what kind of rent you could potentially charge to your tenants in these areas. So as you're looking down, you'll see that, each of these neighborhoods actually does have some data, even though there weren't even though they didn't have data in the last one. That's because this is still pulling data from people who are renting out duplexes, which aren't a part of this. People who are renting out their just their houses, their condos, things like that, in these neighborhoods that don't have these types of properties. And also, this is also pulling data from the much bigger buildings, like the 5 and above, the big 8, 12, 20, 50 unit buildings and things like that. A big example being, although down here you see this huge outlier. The north side had a similar thing here within your north side as this one does within your south side. And this is obviously a pretty big outlier with the 4 unit, going way up here near the $6,000 mark. But this, don't let that throw you too much. That's probably mostly actually coming from the big high rises down there, because that's, the near south side has the South Loop and things like that, where there's these big new sparkly high rise apartment buildings with all the amenities and everything. And it's like, yeah, of course they're paying $6,000 a month to live in places like that. So they're not, so that doesn't necessarily apply to, the neighbors that we're talking about that actually have these kind of smaller 3 and 4 unit properties. Okay, so what we're looking at here is, so the blue columns are the average rents for 1 beds. The red is average rents for 2 bed units. The yellow is 3 bed units, and the green is 4 bed units. And then the orange is just the average overall rent for that neighborhood. So just throw all the units that rented for anything in a bucket, take the average of that. That's what the orange column represents. That's what that number is. And for the most part, you can kind of see the pattern looking as it should. 4 bed is more than 3, 3 is more than 2, etc. And you can also see that by and large, areas that cost a little bit more to buy in also cost a little bit more to rent in, although that is not necessarily a 1-to-1 ratio, as we'll find out in the coming graphs where we talk about actual cap rates and ROI and that kind of thing. So an important thing to note from this graph for the metrics that I have coming up that I'm going to talk about is the fact that I am using So when I talk about cap rates and 1% rule and different things like that, I'm using the average overall rent for all of those numbers. Okay. I'm not getting into like, well, if you bought a 3 unit that had like this distribution of bedrooms and different units and things like that, then that's versus, that'd be a ridiculous video, and nobody would want that. I wouldn't want to record it. It wouldn't be helpful. What I'm doing instead is just taking the average overall rents for the whole area, and then applying that to the average selling price for the area, for the number of unit building that we're covering and that kind of thing. It'll make more sense here in a minute, but I just wanted to kind of plant that seed now of what we're going to be talking about in a little bit. So this is the graphs. Feel free to pause this if you want to take take it in a little bit more and see how these neighborhoods compare to each other. But other than that, I am going to move on to a metric that we call the 1% rule. The 1% rule, a term popularized, maybe even coined by biggerpockets.com. If you are interested in real estate investing, which you're here, so clearly you are, and you have not heard of Bigger Pockets, highly recommend you finish this video, watch all my other videos first, and then go ahead and head over to biggerpockets.com. It's a fantastic free resource it's the biggest online community of real estate investors. There's all kinds of blogs and forums and a podcast and videos and webinars and just everything you could ever want in there. It's a great resource, and was instrumental in me getting into interested in real estate investing myself. So with that all being said, what the 1% rule is essentially just the gross monthly rent that your property is bringing in divided by the value of that property. So if you have a property that's worth $100,000 and it's bringing in $1,000 a month, you're at 1% is essentially the idea there. And years ago when it was when this whole idea was kind of created, I think it was an idea that like investors would see if that 1% rule was met, then that's kind of like one check, box to check off of like, okay, this is a good investment. There are a ton more variables to it than that. There's a lot more to it than that. Just because it's above 1%, doesn't mean maybe maybe vacancy rate is higher, maybe the turnover is higher there, maybe the renovation costs or the taxes are higher. There's all kinds of things that could be playing into this. So don't necessarily say, okay, it meets the 1% rule, must be a good investment. There's more to it than that, but it is still a pretty good metric just for comparison. And, like I said, it's like one more kind of box to check off. So with that all being said, this is how the various neighborhoods on the north side of the south side shake out. You can see like on the low end, the Grand Boulevard is coming in at like 0.7% for the 3 units though, and then on the highest end, New City and Englewood are killing it, almost 2%. 2% on the 1% rule. So, you'd almost have to rename it as 2% rule for them. I think that's the highest I've seen, this is the 4th video, unless there's one in the far south side that I forgot about. Those are the highest ones. So, let's see, what's this one? West, I think that's West Englewood. That one's up there too, 1.75%. And then, you can kind of see what the rest of them have going on from there. I don't want to spend a ton of time on this one, but I just think the 1% rules is a 1% guideline, I'll say. It's just it's a neat little way of comparing things in an apples to apples manner. So next, I'm going to move on to a separate or another metric that you might be a little bit more familiar with. If you have been around in real estate investors, or if you are a real estate investor or spent any time in this space at all, you've probably heard somebody refer to their building as like a 6 cap or a 8 cap 2 caps, something like that. Some number and then cap. This is the number that they are referring to when somebody says that. So what a cap rate means, it is the net operating income divided net operating revenue, whatever, same thing, divided by the market value of the property. So it's similar to the 1% rule, kinda, but also kind of not, right? So the 1% rule was gross monthly revenue. This is net annual revenue. Okay. For this to happen, I had to, just full disclosure, this graph is a little bit more art than science on my part. I had to come up with just sort of like some average expenses that are out there. So like, for example, I have 8% vacancy, 8% for the management fee, 8% of the revenue coming in, 8% for the management fee, 10% combined for saving for maintenance and capital expenditures, various, average utility costs, insurance costs, property taxes. I have 1.5% of the value of the property as a property tax estimate. All of these are very, very subject, like case by case, and in the real world, might not necessarily make sense. You might have to, the taxes might only be 0.5% of the value of the property that you're buying it at, but the property might be such a case that you want to save like 20% for capital expenditures. Your individual situation is going to trump anything that I'm talking about here, but it's still, this is still, I think, a helpful exercise in that it's consistent across the board. And again, sort of that apples to apples. So what we're looking at here is the cap rates again. So blue columns are the 3-unit cap rates for 3 unit buildings. Red is for 4-unit buildings. And again, in a lot of these areas, Englewood and New City especially, near South Side actually has at least a couple to go off of there. West Englewood, for the most part, you see, except for here at Brighton Park, you see just the more units, the better, the more bang for the buck you get, because you're bringing in that whole extra income stream and not paying that much more for it. And, if we had 2 units in here, 3 units would be higher than 2 units, and 2 units would be higher than just renting out your house or your condo. This is kind of how it goes. Not to say that 3 units is bad. That's why I'm focusing on 3 and 4 units. But anyway, yeah. So this is what the cap rates are looking like in this area. Again, like Englewood and New City are way up there. Average 15, 16, something along those lines. Cap rates for 4 units. Even the 3 units over here in West Englewood are getting like a 12%. You see, a lot of them are creeping up towards 10%. These are strong cap rates for sure. Obviously, do all your due diligence and all the other things that matter. But as far as this numbers wise, this is what it looks like. So next, we're going to move on to some more long-term metrics that are important as well. Okay, so everything that we've been talking about so far are sort of the here and now metrics that are very important. Don't get me wrong. These are all the very upfront, like how much does it cost to get in? What's the revenue I can bring in? How much? What's my potential profit? Am I making money every month? Am I losing money every month? These are obviously very, very important things to know. You don't want to buy a property where you're losing money every month, regardless of how much it's growing over time. You're probably just not going to be in a strong and an advantageous position, let's say. But let's assuming that you get that part right. Those are the things that create income for you. But let's talk about the things that create wealth for you. That is coming in the shape of appreciation of your asset over time. So this is what happens, 5, 10, 15, 50 years from now, when you say, wow, this property, this asset that I have is worth this much more. now you have all kinds of options. You can do a refinance. You can sell at a huge profit. You can, do whatever you want with it. You have some really good options there, and that's a result of the appreciation, the growth rate over time. So what we're looking at here is the blue columns represent 2 to 4 unit properties. The growth rate of 2 to 4 unit properties for these areas, average annualized growth rates over the past 5 years. The red columns represent just the past year. So the how much has grown, or in one case declined, in terms of percent, just over the past 12 months as of the collection of this data, which was again about June of 2021. And what you see here is some of these are crazy high. I mean, Englewood in the past year has gone up. The average 2 to 4 unit property in Englewood has gone up by 50% over the past year. Same with West Englewood, Woodlawn. Some areas like that. Pretty much almost all of them are approaching 20%, both on the either on the 5-year average annual growth rates or over the past year. Let's see. I mean, even like the lowest ones, like Bridgeport, is still doing pretty well. Like, it might not look like it, but when you see, that's probably what 8 or 9% average annual growth in the past 5 years. Like, that's still pretty good compared to average national average growth rates and things like that. It's only this, Washington Heights, I think is what this one is, that has gone down in value in the past year, but that's quite an outlier when you consider that it's been going up 23% or something like that over the past 5 years. So, and none of this is to say that if you buy a building in one of these areas, like if you bought a building in West Englewood, it's not necessarily like, especially if it's a fully renovated or new construction building, is probably that particular building might not necessarily increase by 30% a year every year like the rest of the neighborhood is doing. So, don't necessarily see this and apply it to individual properties in that kind of way, but it is an indicator of what's going on in these areas just on a broader scale, as the development that's going in, the investment that's going into these areas. Some of these areas have places where you could pick up properties for just a few dollars, literally a few dollars, just a few years ago. And the city was creating opportunity zones and things like that, to incentivize investors to come in and revitalize it. And that's what's happening. That's why, these places are getting harder and harder to find these, $5 properties. Now they're all going for, hundreds of thousands of dollars instead, like that. And that's raising the tide of the whole area. And that's what we're seeing here, in the form of these, at times, just straight up ridiculous looking growth rates. So yeah, that's what's going on here. And I hope that wasn't too confusing. And let me know if you have any questions on that. All right, that concludes my discussion on the north side of the south side of Chicago. There should be another video coming up. You might be seeing a little bubble for it already, where I get into the far south side. And I have other videos where I go into the north side, northwest side, and west sides as well. And I also have a video where I even go into sort of a big meta analysis of comparing all these sides to each other. So that's a good one as well. That's like, if this is a 10,000 foot overview, that one's like a 100,000 foot overview. But I still think it's quite helpful if you're just getting started and looking for a direction of where to go with this stuff. Another resource that I have available is a newsletter that we hand analyze each 3 and 4 unit property that comes to the market in Chicago. within just a day or two of it being released to the public. And we analyze it in terms of a lot of the same stuff that we went over here: cap rate, potential rents, what it's what neighborhood it's in, the list price that it's at, and all kinds of other things. So if you're really serious about investing in 3 or 4 unit properties anywhere in Chicago, I don't think there's a better resource out there than that one right now. So there should be a link to sign up for that somewhere around here as well. And again, my name is Jake Lyons. If you found this to be helpful, I hope you did. Please like, subscribe, comment, share, and I look forward to seeing you again. Thanks.